Hi, everyone. Thanks for joining our webinar today on Trump's first 100 days. We're going to wait another minute or so for a few more folks to join. Not that everybody isn't always exactly on time. All right, people are trickling in. That's good. Give it a few more seconds. Mhm. Okay, well, let's get started. Again, welcome. I'm Dennis Kelleher. I'm the co-founder and CEO of Better Markets, which, for those of you who might not know, is an independent, nonpartisan, nonprofit 501c3 advocacy group that represents the public interest in economic and financial policy making across all of Washington. This year is actually our 15-year anniversary. We were founded in 2010, just 2 years after the 2008 financial crash, and just months after the Dodd-Frank Consumer Protection Financial Reform Law was signed. Before I get to Trump's first 100 days, it's important to step back and take a look at how we got here. We founded Better Markets because there was no question that the economy and the financial systems were no longer working for the vast majority of Americans. Now, there are lots of reasons for that, but a key structural driver, and one that's almost never recognized or discussed, is that the financial system too often no longer supports the real productive economy, creating jobs and wealth for most Americans, as had been the case for decades. In fact, the financial system is too often a mechanism for wealth extraction for the few rather than a wealth creation system for the many. But that's largely because the financial industry uses its economic power to buy political power, which it uses to protect, expand, and increase its economic power. Well, that can mostly be seen in the legislative lawmaking process. It's almost entirely invisible in the regulatory process, which is where laws are turned into a reality or not. Those financial regulatory agencies are supposed to protect everyone with a credit card or a debit card, a savings or checking account, a loan or investment of any type, and those using big tech products. Their mandate is to prevent financial crashes also, which protects everyone's job, home, savings, retirements, and so much more. And literally every American has a deep interest in those financial regulatory agencies working for them. Yet, that process is dominated by the industry's lawyers and lobbyists, and their job is to maximize the industry's profits and bonuses. That's where they use the industry's political power to deregulate the industry, to cripple the regulators and prevent them from policing the industry and protecting the American people. The industry and its allies constantly complain that the regulatory rules are nothing but burdensome red tape. But remember, those agencies are supposed to enact rules that the financial industry has to follow so that customers, investors, consumers, markets, financial stability, and the entire economy, as well as the lives, livelihoods, paychecks, homes, savings, and standard of living of all Americans are protected. When the industry is deregulated, more consumers will be ripped off, investors will lose money, markets will be more volatile, capital will be misallocated, financial products will be mispriced, hidden junk fees are going to proliferate, and our financial system will be more fragile, leading to crises, crashes, and bailouts, and that threatens our entire economy. Now, that's what's at risk from deregulation, and that's been going on for decades. That's what led to the horrific 2008 crash and the 2023 banking crisis. Now, today, Trump is putting deregulation on steroids. In just his first 100 days, there has been deep and broad deregulation at all the financial regulatory agencies, mindlessly tearing down protections that the American people rely and depend on. Now, you've probably seen the news reports about the dismantling of the Consumer Protection Bureau, the CFPB, but that's just the tip of the iceberg. That's been happening to a lesser degree at every financial regulatory agency, and Trump's just getting started. The result of his actions are almost certain to be a catastrophic financial crash, probably worse than 2008. Now, the industry and the allies claim that they've been over-regulated for years and that they have to deregulate so that there can be economic growth. Well, that's just not true. The financial industry has been deregulated for decades, and that's why Trump's massive deregulation is so dangerous and so consequential. It literally comes on top of 4 decades of deregulation. Now, I don't have time to go over all of that, but it is detailed in a report we are releasing today. It's on our website, and the link will be put in the chat. But let me hit just a few highlights. Let me share my screen here, and I'll hit a few highlights. Hopefully you can all see that. The report is Trump's Wall Street deregulation on steroids is going to cause a horrific economic crash on Main Street. Now, this is what's discussed in the report, showing that deregulation since 1980 has been a bipartisan effort through Reagan, H.W. Bush, Clinton, W. Bush. Yes, the crash happens in 08, but there's nothing but red before then. That's deregulation. The 2010 Dodd-Frank Consumer Protection Act was passed. And yes, under President Obama, there was about 6 years of pretty modest re-regulation of the industry. But that came to a screeching halt when Trump arrived for his first term. President Biden was mostly a status quo president from the view of financial regulation. And then, of course, Trump, too, is going to roll it all back again. But that's what we're looking at here is mostly deregulation over the decades. And what has that meant for Main Street Americans? Well, it took 10 years for unemployment to return to the pre-crash levels after 2008. So the crash happens in 2008, 10 years to get back to the level of unemployment. Now, notice on the bottom line, again, this is all discussed in detail in the report. Those are the bonuses that Wall Street paid itself every year, hundreds of billions of dollars over the years. So while Main Street suffered, Wall Street enriched itself. This is a direct result of deregulation. How bad was it? In 2018, the Fed did a study that showed that at the end of 2016, 90% of the American people were poorer by 17 to 35% than they had been in 2007. Think about that. 90% of the American people poorer in 2016 than they were in 2007 due to that crash, which was due to deregulation. It wasn't just people getting hurt, the country was hurt. This shows the gross federal debt to GDP. There's the crash, and that yellow area is what happened to the debt after the crash and before the pandemic. And this shows what? Wall Street posting blockbuster annual profits year after year after year after trillions of dollars in revenue. Now, let me see. We've detailed that in the report that, as I said, you can find on the website. And there's lots more detail there. But there's no dispute that the financial industry has been deregulated for decades. It has caused the American people unbelievable economic pain and suffering, and that has greatly benefited the financial industry, which has pocketed a lot of money. And yet Trump is still going to add 4 more years of deep and broad deregulation. That's going to be great for Wall Street, but bad for Main Street. As I said at the beginning, it's happening mostly unseen at the regulatory agencies, and that's why, in addition to releasing this report today, Better Markets is today launching a dangerous deregulation tracker, which will be on our website. It's going to track in near real time the deregulatory actions taken at each of the financial regulatory agencies across all of Washington. Better Markets is really fortunate to have a team of experts in banking, securities, derivatives, commodities, and a lot more. So in addition to everything else they're doing, they'll be tracking all these actions and publicizing it. Now, to hear from some of them about what's been happening over the first 100 days and what we expect to be coming, let me introduce the moderator for the panel discussion. Amanda Fisher is our policy director and COO and has deep and broad experience across all of Washington policymaking. She spent the last 4 years in senior leadership at the SEC, including the last 2 or so as chief of staff to the chair. Previously, she was the policy director for the Washington Center for Equitable Growth. She also has extensive experience in Congress in both the House and the Senate, where she served in senior positions on the House Financial Services Committee and the Senate Banking Committee, as well as serving as a chief of staff to a member of the House and a policy advisor to the Senate. We're incredibly lucky to have her. There are a few people in Washington with more experience and expertise than Amanda. And with that, I'll hand it off to Amanda, who will introduce you to the panel.
Hi there. Thanks so much, Dennis, for the introduction, and thanks to our audience for joining us today for this very important topic. And I think Dennis described it well. The shadow of 2008 runs long, and that is important to understand as we embark upon this new period of potentially very destructive deregulation. So I am pleased to introduce my colleagues at Better Markets who will be joining me for a panel discussion today. Following their discussion, we're going to open up Q&A from our audience. So please think through any questions you may ask, and we want this to be interactive towards the end. So first, I am pleased to introduce Shana Oleshik. She is our Director of Banking Policy. I am also pleased to introduce Cantrell Dumas, who is our Director of Derivatives Policy. And finally, I am introducing Ben Schifrin, Better Markets Director of Securities Policy. And with that, I would love to get this discussion going because we have a lot to cover today. So let's take it from the top. Setting the stage before we get into specific policy and personnel actions, just want to provide the audience with an overview that the Trump administration has taken a number of radical actions that attempt to reshape how all agencies do their work. This includes executive orders and the arrival of DOGE at the federal financial regulatory agencies. So I'd like each of you to set the stage and flag at least one particular significant action that you're tracking and how it deviates from typical agency practice at the start of an administration. So I will start with my colleague, Shana, who covers our banking agencies.
Thanks very much, Amanda, and welcome everyone. So one of the things that I'm tracking is the cuts in staffing at the federal banking agencies. This is very concerning, especially given the depth of the cuts. At the FDIC, for example, we're expecting about 20% of staff cut. That's 1 in every 5 people that is working to safeguard your bank deposits, protect the health of the banking system. So this is very concerning. Additionally, the focus of the examiners that are working to supervise banks around the country, the focus is shifting. Previously, these examiners had been looking at an array of different risks, including financial risk and operational risk. The leadership at the banking agencies is saying that this focus should be shifting to more of just the financial risk, which is very concerning to me because a lot of the risk that examiners find is operational or new and novel. So essentially, all of this boils down to concerns about the protections that the regulators, the protection that they offer to your bank deposits. So we're definitely concerned.
And for my colleague, Ben, what are you seeing at the SEC in these early days?
Thanks, Amanda. I think we're already seeing the extent to which the desire of the new administration to cut the federal workforce is having an effect. There's always some amount of turnover when the administration changes, but it's usually concentrated in political appointees rather than career civil servants. But as a result of DOGE and the administration's other actions, the SEC has lost 16% of its staff. That might not seem like a lot, but the SEC oversees capital markets of $100 trillion, $100 trillion. It monitors 15,000 investment advisors, 13,000 registered funds, over 3,000 broker-dealers, 25 national securities exchanges, and 100 alternative trading systems. We've put out material previously to show that the SEC is already underfunded. And so if the SEC is now going to lose 16% of its staff, that's going to have serious consequences. And I think it's important to remember, these are the people that are responsible for holding fraudsters accountable, for making trading safe. and for responding to market volatility and disruptions, just like we experienced just a week or so ago. So the idea that cutting staff is going to make the SEC more efficient is quite frankly nonsensical. All it's going to do is endanger investors, markets, and the economy.
And likewise, Cantrell, what are you seeing at the CFTC?
So it's interesting. So I'm not actually seeing or tracking any action from the CFTC. I'm actually tracking their inaction. And what I mean by that is their inaction to enforce the prohibition on sports event contracts. So the CFTC was offered, the Crypto.com and Kalshi has offered sports event contracts for the Super Bowl back in February. And usually what happens is the CFTC will pause these contracts because these contracts involve gaming, which is under statute and under the CFTC regulation. And after they do this analysis, the public interest analysis, they provide a determination, usually 45 days after or 30 days after they pause these contracts. The CFTC didn't do that. Instead, they allowed these contracts to continue, and which is interesting because there's a case, Kalshi is suing the CFTC and the DC Circuit Court under its political event contracts. And in that case, Kalshi has admitted in their brief and in oral arguments that in trying to distinguish political event contracts from sports event contracts, they're saying that they stated that sports event contracts are illegal under federal law. They mentioned that sports event contract has no hedging utility, and that sports event contract doesn't have a place in the derivatives marketplace. Ironically, though, Kalshi is offering sports event contracts. And what it's doing is they're doing a backdoor attempt to make the CFTC a federal regulator of gambling. And the CFTC is not equipped for that because, first of all, CFTC doesn't have enough staff, doesn't have enough resources or the expertise to regulate gambling. And by doing this, it's taking away, and why this matters is it's taking away the CFTC's core mission is to protect the marketplace and make sure that the marketplace that the CFTC regulate are commodities, which are essential to everyday essentials like groceries, gas for cars, airline tickets, things like that. So it's interesting that the CFTC decided not to take action on something so important to where eventually it's going to affect everyday Americans to where it's going to open up gambling if the CFTC doesn't act soon to stop these contracts.
So, okay, what I'm hearing is drastic cuts among the federal workforce, and Dennis mentioned at the top the attempted dismantling of the Consumer Financial Protection Bureau as a whole. I'm hearing the diminishment of career civil servant expertise and judgment in decision making, and I'm hearing inaction combined with some CFTC being asleep at the switch as novel products are introduced that ought to be properly regulated. So very concerning. But now that we've set the stage, I do want to pivot to personnel. We've gotten to the point where all of the heads of the financial regulatory agencies either have been announced or they've been confirmed and taken over their positions. So as we see these initial days of their tenures, I would love our staff's feedback on, early report cards or at least insight into how they think that these new appointees may fare. So Ben, we got a new SEC chair as of last week. What are your early observations?
Thanks, Amanda. We certainly do have a new SEC chair. And what I think is interesting about Chair Atkins is that he has a long record, both at the SEC when he was a commissioner and representing companies with interest before the SEC after he left. And so I think we have a pretty good idea of how he'll lead the agency. And I do think this is a situation, it's not a situation where they're going to say they're going to do one thing and do a different thing. I think Chair Atkins is forecasting exactly what he's going to do and what we should expect. And what I think we should expect is deregulation on a massive scale. I think that his record and his previous statements indicate that he just believes in deregulation. And so I think he's likely, and the SEC is likely to adopt policies, for instance, that favor corporate management over ordinary investors, such as in the proxy process. And we saw then acting chair Ueda do exactly that. I think we can see rules that facilitate risky behavior on Wall Street, such as unrestrained short selling. And I think we will see amendments that allow private funds to sell to retail investors, such as by amending the definition of an accredited investor. I also think Chair Atkins is likely to reduce the SEC's involvement in measures that were adopted to prevent another financial crisis, such as the creation of the Financial Stability Oversight Council and the SEC's whistleblower program. The last thing I'll say is that I thought Chair Atkins's confirmation hearing was pretty interesting because he was asked about his tenure during the commission between like 2002 and 2008 in the lead up to the financial crisis, when there's no question that the SEC, made some mistakes and you would think might have wanted to do some things differently. And he was essentially asked, do you think you made any mistakes? And he said no. And that's pretty remarkable. You can understand the perspective that he has, but with the benefit of hindsight, you might think he would say, yes, I would do some things differently. But given that he doesn't think he should have done anything differently back then, he's probably not going to do anything differently going forward.
Concerning. Cantrell, what are your early reflections on CFTC personnel?
So it's interesting. So Brian Quintez has been nominated, but he has not been confirmed. But like Ben mentioned before, there's a record, and the record is that he is for deregulation. Clearly, from his time at the CFTC, he was for obviously a light touch regulation. He's believe in innovation. His approach is that too much regulation will snuff out innovation, and that innovation is good for the marketplace. That well, I guess he resigned now, but after the CFTC, he joined a venture capitalist firm where they're responsible for providing seed money for cryptocurrency firms. So he definitely believes in a light touch in terms of cryptocurrency. If the CFTC is granted to be the main regulator for Bitcoin, I can foresee him being the chairman, providing a very light touch on digital assets. Very interesting, though, after the FTX crash in 2022, his stance was the fact that federal regulators shouldn't overreact for this crash. He believes that it's still that any crash or anything like that should not be snuffed out, or any overbearing in regulation will definitely take away from innovation. And he also believes in, which is interesting, that the market shall police itself, which is quite, the analogy I would use is that criminals will turn themselves in to the cops once they do a bad deed. So as facetious as that sounds, he believes that the marketplace is his own cop and they should definitely police themselves.
Concerning, and Sheena, you cover a number of our federal banking agencies, and curious what you're seeing in terms of leadership there in these early days.
Yes, so at the banking agencies, we're still in a transition period for the Federal Reserve, the FDIC, and the OCC. We have a nominated vice chair for supervision, Michelle Bowman, and at the FDIC, we have acting chair Travis Hill, and at the OCC, we have a nominated head, but still currently the acting comptroller Hood. All three of these individuals say they have the public interest in mind, but I'm already concerned with the actions that they've taken in their acting roles that really look like they have more of Wall Street in mind, or certainly the Wall Street banks have their ear. One example of this is the fact that they have reversed the Community Reinvestment Act, or CRA. This rule was approved in 2023. And while it wasn't perfect, it was definitely better than prior versions of the Community Reinvestment Act. And for those of you that are not familiar with this, this lays out the expectations for banks in serving their communities, especially underserved parts of their communities. So the fact that that the agencies have already started to roll back protections that clearly had the best interest of Main Street in mind, I think is a worrisome sign. But we'll have to wait and see once we have confirmed heads for the banking regulators.
Indeed, and something else Better Markets has tracked, in addition to all of these personnel appointments, is frankly the firing of Democratic commissioners, minority commissioners at multi-member commissions. Folks may be aware that at the FTC, the 2 Democratic commissioners were fired approximately a month ago, testing long Supreme Court precedent that actually provides them with a degree of protection in order to insulate these important regulatory and law enforcement agencies from political whims and to give them the bipartisan input and structure and deliberation that they were intended to have. And then, of course, two of the board members at the National Credit Union Administration were similarly fired in the last week or two with another test case. So just a dangerous situation with personnel appointments combined with what looks like some test cases to see if all of these multi-member commissions can be turned into partisan single director structures or partisan, multi-member scaled back structures. So with that in mind, I think it would benefit us to spend a little bit of time on some of the substantive dismantling of the rules that we've already seen in these first 100 days. And Cantrell, you earlier mentioned that the CFTC is inactive. So I'll direct these questions to my colleagues, Ben and Shayna. But Ben, we've seen a very active SEC. So why don't you point out for the audience maybe your top three actions that have you concerned?
Sure. Thanks, Amanda. I think it's hard not to start with crypto just because there's been really a 180-degree shift in crypto policy from one administration to the next. And I also think that's where the new SEC started. Just a couple of days after the inauguration, the SEC rescinded guidance that was designed to ensure that banks that held crypto assets had enough capital to protect against the risk of loss. And now that guidance is no longer in effect. And we kind of saw the problems with the rescission of that guidance not long after, about a month or so after, there was the Bybit hack, where a record $1.5 billion of crypto assets was stolen. And so it's now very troubling that there aren't going to be rules in place to guard against the risk of theft and loss like that. Shortly after that, the SEC dismantled the crypto enforcement unit. And I think whatever you think about crypto, it's just made manifest that it's an area in which there's a lot of fraud. And so you would think you would want to at least have a unit at the SEC dedicated to policing that fraud. Instead, the SEC dismantled that unit and formed the Crypto Task Force. And the Crypto Task Force main job seems to be, biweekly issuing statements discussing just the extent to which the SEC doesn't think crypto should be regulated. The one that most caught my eye is the statement on meme coins, where the SEC says generally it's not going to regulate meme coins. It's going to treat meme coins like collectibles, as if they're like baseball cards. And I just don't think that's the way meme coins work. People don't, buy a Caitlyn Jenner meme coin and try to trade it for a Jason Derulo meme coin. They buy it as an investment. People have lost life savings investing in these things. So that statement and the overall approach to crypto is just very troubling. The second one is, again, kind of 180 shift on climate and ESG. The most prominent move was Acting Chair Ueda's statement that he wasn't going to defend the SEC climate rule in the Eighth Circuit, and then the commission's vote saying that they were no longer gonna proceed with the defense of the rule. And so talk about dismantling rules. I think, we're no longer going to have that rule, which is very unfortunate. I think it's a pretty hard case to make that information about climate risk just isn't material to investors in this day and age. So that's the second one I would talk about. And then the third is in the private markets. The SEC, pretty much right after the change in administration, approved the trading of a private credit ETF. That's troubling because ETFs are supposed to be liquid. Most people think they can buy in and out of them pretty quickly, but private credit is illiquid. You have the underlying assets are illiquid, and the staff actually raised these concerns the same day as trading was approved. The sponsors of the ETF came back and said, no, it'll all be fine. And the staff seems to just have accepted that. But I think we're going to see problems in that area. And there was also a no action letter that essentially gives investors the ability to self-certify whether or not they're accredited, which is exactly the opposite of what the SEC rules say is supposed to happen. So I think we're going to see a lot of risk in the private markets as well.
Fully agreed. I know a lot of observers that watched that ETF approval were pretty surprised by it, and particularly at this point in the economic cycle with a recession potentially on the horizon, the idea that these private illiquid poorly disclosed assets are going to be shifted onto retail is very concerning. Shayna, how about in the banking space? What are your top three?
Thanks, Amanda. So I too will start with concerns about crypto, but my concern here is allowing crypto activity into banks. As Ben said, and as I think many people on this call are aware, crypto is well known to be dangerous and riddled with fraud and risk. And previously, there had been guidance on the books that said if a bank wanted to get involved in crypto, it first had to go to its regulator and explain how it was able to manage this risk. With the action by the Fed this week, all three banking agencies now have changed their tune, and now crypto activity is allowed on banks' books without that prior approval. Banks are still accountable for managing this risk, but my concern is that may be too late. So this is very concerning to allow crypto into the banking system. Secondly, the Fed has began the process of weakening the stress tests. These stress tests are applicable to the largest banks, the most systemically important banks, and the banks that are too big to fail or could do the most damage if they get into trouble. As we all know, the economy and financial system is very volatile, but what the Fed is doing at the urging of the largest banks is making the stress test more predictable. So doing the exact opposite of what we think they should, the banks should be able to be resilient in the face of economic and financial volatility. But instead, they're handing over the answer key and giving more transparency to the banks about what might be in these stress tests, and really making the results of them much less meaningful, both for the regulators and the public. Finally, related to bank mergers, we've all seen the headlines recently of the merger between Capital One and Discover. My concern here is that there have already been changes put into the works that make mergers easier and taking protections that previously had held banks accountable for explaining how the banking system or consumers are better off after a merger. Those protections are being reversed. So lots of trouble from all angles on the banking regulators.
I would say that it's concerning to me that in our brainstorming for this session, we had a hard time narrowing it down to three. So, I mean, those are just some of the top risks that we flagged, but even 100 days in, there was more than could fit in that answer. But pivoting to the other important mission of our financial regulatory agencies, they are law enforcement agencies. And we have seen some early signs about a change in the enforcement posture at these agencies that I think that the public should be aware of. So, Cantrell, let's start with you. What are you observing with regard to the CFTC?
Yeah, so at the CFTC, Acting Chair Carolyn Pham has issue out guidance. The Division of Enforcement issue out guidance to where they narrow their posture or narrow their focus to fraud and manipulation cases that cause customer harm. When that may obviously appear like a good thing, there are other things that affects the marketplace that everyday Americans should be worried about, such as compliance issues. The CFTC under Dodd-Frank has the main regulator over derivatives markets, swaps, and things like that. And not too many people are aware of or familiar with, but there's a lot of compliance issues that comes with that. And sometimes you have repeat swap dealers that do the same thing over and over again. And these same bad things is taking away transparency, take away the things that, the pillars of financial stability. So when you take away looking at compliance issues and really doing a deep dive on these compliance issues, but mainly focus on things such as egregious fraud, you necessarily you're taking away a pillar of stability to where you're not really focused on the compliance issues that a lot of these swap deals, a lot of these large market players are doing.
That's really helpful, and I'll just plug that Better Markets tracker of administration actions is going to include both enforcement policy changes at the agencies and the dismissal of all of these cases. So we've been tracking them. There's a lot, even in the first 100 days, including at the CFPB, which I would be remiss if I didn't flag that they've dropped cases against payment providers, large banks, credit reporting bureaus, lease-to-own companies, mortgage companies. So the change in posture is pretty wholesale across our financial regulatory agencies. Okay, so I want to save time for Q&A, but maybe we can do a quick lightning round before we get to the Q&A. And this is for all the panelists, but the folks want to know what source of systemic risk keeps you awake at night. And as you think towards potential causes of the next financial crisis, where do you think that lies? So I'll start with Shayna, since you cover the banking agencies.
Sure. Thanks, Amanda. So I think the thing that keeps me up at night is the big banks getting bigger, but even beyond that, becoming more connected with non-banks and fintechs. So when we think about the financial system broadly, we have banks and we have non-banks, such as fintech companies, hedge funds, insurance companies. And at least in the United States, the non-bank sector is almost 3 times larger than the banking sector. The banks have about 24 trillion in total assets. Non-banks have over 70 trillion. And non-banks are much less regulated than the banks. So when banks are lending to non-banks and becoming even more connected, those risks can transfer to the banking system. I'm very worried about those interconnectedness and the non-banks getting even larger.
Well, Ben, what about in your space at the SEC? What sources of systemic risk keep you most concerned?
Yeah, so what generally keeps me concerned is that we never seem to learn the lessons of history. We failed to properly regulate public company accounting, and it led to Enron and WorldCom. Then we failed to properly regulate derivatives, and it led to the 2008 financial crisis. Now it seems like we want to not regulate anything. What are the chances we're going to escape without an even more damaging crash? The one issue I'll highlight that really worries me is the treasury markets. I think we saw just how fragile they are just a couple of weeks ago. But the treasury markets are the backbone of the financial system. If something goes wrong there, the cascading effects are just going to be tremendous. And what's remarkable is, given how trading in the treasury markets have evolved in the last few decades, we're now left with a treasury market that's really opaque and unregulated. And that's a remarkable thing to be said about such an important space.
Ooh, and Cantrell, what are your concerns?
It's an interesting question, Amanda. There's a combination of things. One is this idea that innovation, overregulation kills innovation, and that's the theme that the CFTC is a posture they're taking, moving with the nomination of Brian Quintes, that the market can police itself. And like I mentioned before, it seemed like a preposterous notion, because we all know that from past history, that the market doesn't necessarily police itself. It tries to think of innovative ways to make more money. And when you think of innovative ways, you're less likely to consult with the regulators to think about ideas or ways of compliance or ways to provide guardrails. You do it until something happens. And I'm afraid that there's going to be some innovative product or something that's going to come up with the lack of CFTC regulation or lack of CFTC oversight that is going to blow up the financial marketplace to where you're going to have contagion. So we don't know what it is yet, because obviously Brian Quintes is all about innovation, but I'm sure it's going to be some type of innovative market, innovative product that's going to be the next best thing, where it's going to be lack of oversight, and the next thing you know, contagion is going to happen.
Yeah, I think we're all concerned, and part of the reason why we launched the tracker of deregulatory actions is that all of these dials are being turned, in some cases slightly and in some cases drastically. And you know, in financial markets, you never know when something may break or what may break. And this combination of all of these changes with all of these personnel are very concerning for us when it comes to financial stability. So I just want to give folks another reminder. I think we have time for some Q&A, and I encourage you to put your questions in the chat. To start off, I might just cover one topic, moderator's privilege, since it's in the news so much today. Better Markets has been tracking the administration's chaotic tariff policy and the downstream consequences that it may have for financial markets. So maybe, Shayna, if you want to start off, like for folks that hear a lot about the tariffs and maybe want to understand the implications beyond, you know, what it does to the stock market, what are you looking at in the banking system?
Thanks, Amanda. You know, I feel like we got a pretty clear answer from Fed Chair Powell a couple of weeks ago when he clearly said that the tariffs are increasing uncertainty in the economy and can certainly lead to a downturn in economic growth. We're already seeing forecasts for GDP showing that a recession may be on the horizon. So what does that all mean to the banking system? Well, you know, we've seen what's happened in prior recessions. People have trouble repaying their loans. That leads to banks seeing trouble and eventually bank failures. So, you know, I think that this is a recipe for a lot of problems in the banking industry.
Ben or Cantrell, do you have anything to add there, or shall I go to the Q&A box?
So I'd like to add that, you know, tariffs causes volatility, and in the commodities marketplace, volatility is a sign for a lot of speculators to make a lot of profits. CFTC did a rulemaking in 2020 on its position limits, and better markets have been beating the drum for the CFTC to produce a report or some sort of analysis as whether or not the 2020 position limits is working. Position limits is a very important tool that CFTC has to where it makes sure that the commodities that are being traded in the futures markets are not necessarily have over speculation or any manipulation, which harms everyday Americans. Because as I mentioned before, commodities in wheat or corn can affect cereal, or can affect other commodity in gas or oil, can affect the gas and car, airline tickets, or lumber. So in volatility, we don't know yet whether or not the CFTC position limit is working. So with volatility, you have a change in commodity prices and a change in contract prices. We don't know if position limits to where these speculators are right size or should be smaller or not. So, you know, when the rise in prices of tariffs may be tariff may be the cost of it, you know, supply and demand is the cost of it, but also position limits. That's also a possibility that the position limit is not at a point to where it right size to where the commodity prices are large, therefore it affects everyday essential items.
Fascinating. Something to watch. Let's pivot to the Q&A box, and I'm just because it's so timely, I'm going to pivot to this question first. We have a question from Carol Wayman, our colleague from the Senate, and she has a question about the House proposal to abolish the PCAOB and fold it into the SEC, and what are our thoughts on this proposal? So this is timely because Better Markets has just published something on this. It should be up on the website shortly if it's not already. But Ben, do you want to discuss our high-level thoughts on the PCAOB?
Sure. Thanks, Amanda, and thanks for the question, especially because I think I just mentioned how one of the things I worry about is, you know, we fail to properly regulate public company accounting. And then, you know, we saw Enron WorldCom, and I'm worried about the same thing happening exactly with respect to a proposal like this. You know, we've kind of seen what happens when we don't have an effective regulator of the big audit firms, and I don't want to go back to that world. And I think it's especially troubling that there would be a proposal to merge functions of the PCAOB into the SEC. Now, when we just talked about how the SEC is down 16% of its staff, and now you're going to make it regulate the huge accounting industry as well, that just doesn't seem to make sense. And then the last point I'll say is it's not like this would save money. The PCAOB isn't funded by taxpayers, so it's a bit hard to understand, other than the fact that, 20 some odd years have passed since Enron and WorldCom and memories have faded, why you'd want to do away with the PCAOB now.
Definitely concerning. And one last point that we note in our fact sheet is that the PCAOB is currently the party to the MOU allowing for inspections of China-based audit firms. And if the PCAOB were abolished, all of those would need to be renegotiated. And it's unclear if the Chinese authorities would accept having the SEC directly examine the books and records of their audit firms. So a lot's at stake, and I know a lot of congressional members fought hard to ensure that the PCAOB could go and inspect China-based audit firms. There's a lot of crypto questions that I want to get to, but before we get to that, I want to ask Shayna this question from Evan Weinberger about the consolidation of federal banking agencies. Besson has said it's not on the table, but he wants greater coordination. What do you think the risks are to either consolidation or coordination, just given your experience at Better Markets and then as a longtime FDIC employee?
Yeah, thanks, Amanda, and thank you, Evan, for the question. I see a lot of risk to consolidation among the different banking agencies. For one reason, each of the banking agencies has their own focus. For example, the FDIC focuses on community banks. So if that were to be folded into another agency, we may have much less focus on community banks and just getting overshadowed by larger banks. What we're already seeing at the OCC, I think, could be an illustration of what's to come. Within the supervision function of the OCC, all of the supervision for the mega banks, for large banks and regional banks and community banks has all been merged into one group. I think there's something to be said for the wisdom of coordination, but if everything gets mixed together, we get less focus on risks throughout the system. So I see a lot of concerns there. The final point of my answer is if everything gets folded under the OCC, which is what some of the early reporting was, that's all controlled under the Treasury Department. So we would lose the independence that we have in banking regulation currently at the regulatory agencies. And I would point to a study that we've highlighted that looks across countries. I think it looked across 80 countries or something over many decades, and showing that independent financial regulators leads to more financial stability. So I think this is problematic from a lot of different angles.
Indeed. I will pivot to a question about the CFPB that we have in the chat, which is what happens if it's greatly reduced or effectively eliminated? Who is going to enforce the consumer protection laws? It so happens that Better Markets just put out a fact sheet on this to talk about the unique role of the CFPB in consumer protection. I'd urge you to check that out. But the quick answer is that it creates some really perverse incentives because the banking agencies can only enforce consumer protection statutes for those small banks. And it was part of the negotiation under Dodd-Frank that the CFPB would not cover the smallest banks. And also there would be no non-bank enforcement. The CFPB is the sole federal regulator of non-banks that are engaged in financial activities. So the state attorneys general can enforce the Consumer Financial Protection Act. That is important, and that's a great bulwark against these rollbacks, but they cannot fully pick up the slack. And the FTC has narrow authority related to unfair and deceptive acts and practices, and the FTC themselves are under siege. Their Democratic commissioners were fired. So I think that the end result would be we're going to see a lot of consumer harm. Folks are going to get their money stolen without redress, and the CFPB has been very successful at, both enforcing the law and receiving consumer complaints to expedite responses from financial institutions. So deeply, deeply concerning, and in fact, banks should be concerned that non-banks that engage in the same activity are getting a free pass. So that's the CFPB. But maybe we can pivot to maybe we should do some of the crypto questions. There's a few in here. But I think that the one that's top of mind for most of us is, what does all of this mean for systemic risk, and how could crypto import its lack of compliance and its risk into the broader financial system? I think we all saw what happened in 2022, and the silver lining of that was that it strained some of the banks that ended up failing or teetering, but it didn't cause a wholesale financial crisis. But that may be changing. So I don't know if Shayna, you want to take the first bite of it as someone studying the intersection of crypto and the banking system, and then maybe Ben and Cantrell have something to add about systemic risk.
Sure, Amanda. So, as I said earlier, it's really concerning to me to see crypto being allowed into the banking system. It makes me think of the FBI report that was just released last week, I think, that showed the incredible increase and the breadth of fraud that's happening in the crypto space. So this is not just our opinion that crypto is dangerous and brings about a lot of fraud, but it's proven by the data. So to allow that into the banking system, particularly among smaller community banks that may not have the systems or the capability to recognize that risk is really concerning to me.
Systemic risk in crypto, and also this claim by some of the industry that the question cites that it's actually a hedge against other financial assets. Ben or Cantrell, do you want to take a shot at that?
Well, just on that last point, I think that's always been the crypto party line, but recently we've seen that's not the case. There was no underreporting in the recent market turmoil about, and even months previously, about how crypto assets were moving in the same direction as the rest of the market. And so I think the evidence that it's somehow a hedge is diminishing. With respect to systemic risk more broadly in crypto, the one thing I'll add to what Shayna said is, it's such a volatile, crypto in general is so volatile that as it gets intertwined with the traditional financial system, it's impossible to believe that volatility won't spill over. I think even the crypto industry recognizes this, which is why they've started making their main pitch to integrate crypto with the traditional financial system, stable coins. But I think it bears mentioning that stable coins, despite the name, aren't that stable. In fact, we refer to them as unstable coins. They've put out a fact sheet demonstrating the extent to which they are unstable, the extent to which they aren't able to maintain their peg, their one-to-one ratio to the dollar. So I think, everybody just has to recognize that something that's called a stable coin doesn't necessarily mean it is stable, and isn't really any better than mixing other crypto assets in the traditional financial system.
And I would just add that Better Markets has put out a number of materials on the pending stablecoin legislation and how further integrating the risks of stablecoins into the banking system would threaten financial stability. And the last point I'll make on crypto is that we do see leverage returning to the crypto marketplace, particularly retail leverage. A lot of this was shut down or inhibited during the Biden administration. And, in the last 100 days, we've seen a return of products offered by crypto trading platforms and their affiliates to allow users to deposit stable coins, earn a guaranteed yield, and then on-lend those stable coins to other institutional market participants that may be using it in trading schemes. And this is the same type of arrangement that we saw with BlockFi and Celsius and Voyager and Nexo and some of the infamous crypto bankruptcies that happened over the last 4 years. So the leverage in the system is something I'm also looking at and concerned about. I think maybe we can do two more before we wrap. Is there maybe we can go to FSOC/Treasury markets. How do we see the administration using FSOC differently than the last term? And I'll start with Shayna on that, and then maybe we can pivot to the Treasury market question after.
Sounds good. So for those that are may not be familiar with the FSOC, the Financial Stability Oversight Council is a group of participants and members from all of the federal financial regulatory agencies, as well as some state representation. These are supposed to be the adults in the room watching what's going on and acting in our best interest. The FSOC has had just one meeting this year so far, and we were pretty disappointed with the discussion that took place at that meeting. The good thing was that they had it. The bad news was it was a completely closed door meeting, so there was no public portion of the discussion. There was a report out, which unfortunately we felt did not focus on some of the most important risks that the FSOC should be looking at, namely this non-bank issue that I talked about earlier. So non-banks continue to grow. During the last administration, the FSOC was given the tools to oversee non-banks when they get to systemic size. They can be regulated, and the FSOC has the tools to do that. Unfortunately, they have not used those tools, and it doesn't look like they are going to. So, that's really concerning that these are the people that should be, identifying these risks and taking action to protect the entire financial system and protect, all of our money from the risks that they see. And it just doesn't look like there's much action there. So very concerning.
And then with regard to Treasury market structure, maybe we'll just put a pin in this, and I'll flag that we understand that there's going to be a congressional hearing in the House on this topic in mid-May. So watch out for Better Markets. We're going to be discussing what we think policymakers' priorities should be to ensure the stability of the Treasury market, going over what's been done and what still needs to be done. But maybe we'll close with this, and I'll go around the horn, starting with Cantrell. Can you describe in one way how the actions being taken in these first 100 days could negatively impact someone's life, just someone on Main Street that does not follow financial regulation? What is the way that they're going to feel this? And this will be our wrap-up question around the horn.
So I go back to my point about tariffs and the position limits to CFTC. The CFTC, obviously, the one thing that I could point to that affects mainstream Americans, obviously, is the commodity prices, which affects everyday essentials that I mentioned before. So I think the Trump administration tariffs war, or the war, or trade war, can definitely create volatility in the marketplace. And in that volatility, a lot of speculators, as I mentioned before, benefit from that, and as we saw in the pandemic. So one of the things that I would be as an everyday American, mainstream American, is to make sure that the trade war, things like that, there's no other factor that's included that increase certain products, certain commodities, right? So I would actually demand to see a report or from the CFTC to see that these position limits that we've mentioned at this roundtable or this webinar are in place, are safe, are necessarily working as it's supposed to work. So as it stands right now, we don't know because the CFTC has not produced a report as required by Congress to produce a report whether or not these position limits are working.
And Ben, how do you think folks on Main Street could see these actions affecting their daily lives?
Yeah, I think that mainstream investors are going to start to see really risky products being marketed to them that in a way that hasn't been done before. And it's going to expose them to products that may be unsuitable for them. The private credit ETF is a great example. I think that I've read a lot about how the private markets, want retail investors to invest in their assets, that they're coming after your retirement savings, they're coming after your 529 plans, things like that. And I think that people just need to understand that just because they want you to invest in those assets, that is not necessarily what should happen. I always laugh when I see the headlines like, private credit's coming after mainstream Americans' 401k. They want to get into mainstream Americans' 401k. Well, do mainstream Americans want them to get into their 401k? I think that's an important question that needs to be asked.
And Shayna, we'll cap it off with you. How do you think these policy actions could affect just working people that don't necessarily follow financial regulation?
Thanks, Amanda. So I think about trust in the banking system and the fact that everyday Americans put their money into banks because they trust that banks are a safe place for that money. These are people's life savings, and as we see the agencies, as we see the staffing be reduced and rules be changed, I think that I hope that trust is not eroded, but I worry that that we may see more and more policies that undermine that trust.
Very concerning. We have hit our hour. Thank you so much to the audience for spending the afternoon with us, talking about these important but concerning issues. And I would just urge everyone, visit Better Markets website. We have a wealth of resources. We're going to be tracking all of these Trump administration actions. We have great analysis and commentary on what's happening, and stay tuned for more events like this. Thank you so much.